Welcome everybody. This is the FEI Louisville April chapter meeting. Again, we're over Zoom. It's going to be PNC is here today. We're excited about that, and they're going to be presenting finance trends. Oh, good. Go on back again if you don't mind, Terry. They'll be discussing finance trends and paths for busy executives. Also today, we're going to have our annual FEI Academic Honors Ceremony too, which we'll get to before our presentation from PNC. Okay, next slide. Thank you, Terry. I'm Matt Montero, FEI Louisville President and a longtime member of FEI. Welcome, everybody. We want to give a shout out to our sponsors. A few years ago, we started the gold level of sponsorship, and we have some longtime sponsors that have come on board as our gold sponsors. Chase Bank, thank you very much for being a gold sponsor. Also MCM, CPAs and Advisors, and VACO, and our newest gold sponsor, U of L Health. Thank you, everybody. We also have several silver sponsors. We want to welcome you all and thank both our gold and silver members for their contributions. We appreciate your financial contributions, but like we've had with other sponsors in PNC today, the content and engagement is even more valuable. We appreciate it very much, and it enables to put us on some great programs. So thank you, sponsors, for both. I'm going to introduce Mike Wheatley next. PNC has been a longtime sponsor of FEI, and Mike Wheatley and I go way back. Mike, we appreciate you arranging this event today and our speakers. Also, Mike will be giving away a $100 gift card. So that'll be right around noon when we wrap up the official portion of the meeting before we go into our breakout rooms. So if you can hang in there, I know some people may have follow-up meetings, but we're going to try to fit that in right before noon if you can stick around for the $100 gift card. Michael?
Perfect. Thank you, Matt. Can you hear me okay?
Yep, great.
Great. Good afternoon, everyone. And again, welcome. I'm glad you're here. And we're excited about our presentation around financial trends and paths for busy executives. On behalf of PNC, I do want to give some special thanks to Matt, Terry, and Mark for the special opportunity. They put a lot of energy and effort and coordination behind the scenes in pulling this event together. Their efforts recognized and much appreciated. Do want to quickly throw out another shout to the three students, Abby, Renato, and Zachary. You are the future of Kentuckiana's economy. Keep up the great work. You have a bright future in front of you. With that said, the three speakers in front of you today that you see up there, I'm not going to go in. Their bios were sent out. I'm going to give you just a quick little background. Kristen Dunleavy is our Senior Retirement Plan Advisor. Jonathan Johnson is our Senior Relationship Strategist, and Neil Byrne is our Wealth Strategist. Combined, they have over 50 years of experience. We're excited to have them here, and we work closely as a team. But with that said, I'm going to turn the baton over to Neil and Jonathan.
Thanks, Michael. I appreciate that. I did want to make one quick comment to the students if they're still online. It sounds like multiple of you are considering professional designations and trying to chart your next steps. And so I just want you to know on our team, we have people who have all those designations and more. And so feel free, our contact information is on here. Reach out. I'd love to connect you with those people. They can tell you about the pros and cons of different designations they have and the doors and the paths that it opened up. So please feel free to reach out. Beyond that, so I think what we were asked to do was, come up with some planning topics that would be beneficial to discuss with our financial executives. And so, we've got kind of two different groups here that within PNC to share some different ideas. Some are more geared towards the executives themselves and the business owners, and then some are more geared toward the company and how it administers employee benefits and things like that. And so Neil and I are going to kind of cover some of the personal aspect of things for the business owners and executives. And as we started to chew through that and determine what type of topics do we think are really valuable and important for 2021 to discuss, there was some common themes that popped up. Every topic we discussed, it all rooted back to two things. And so those were interest rates and taxes. And so I'm sure there's a lot of rhetoric, a lot of talking heads out there right now that speak an awful lot on interest rates and taxes. And so we do have a couple of key planning points we want to touch on. First, we want to set a little bit of a background and a stage for what the current interest rate and tax environment is and where it might be headed. And so I'll touch on interest rates, and I'll kick it over to Neil, and he'll talk about taxes and then kind of discuss, some planning topics that we feel are always important and always things that our business owners and executives need to be thinking about, but maybe even more so given the environment we're in right now in 2021. Terry, would you mind switching slide? Okay, so interest rates, to sum it up, in short, they're low, right? I think everybody knows that. Everybody's been talking about that. And interest rates have a broad-reaching effect. I think they impact more than people realize. So obviously, they impact your lending. If you've not gone out and refinanced your mortgage, I'm sure you may have plans to. Investments, if you're a retiree or you're participating in your 401k plan, I think it's pretty painfully obvious that interest rates are low on the fixed income side of the spectrum. But they migrate over. They impact estate planning. They impact insurance. And so those are some aspects that I think Neil will add some valuable insight on. One other quick thing we wanted to touch on is Libor and the transition away from Libor. The industry is moving away from that. New loans, the cessation of those is scheduled for this summer. I'm not going to beat that topic too much because I know you had a conversation, I believe, on that itself this past summer. One thing interesting that popped up in the last couple of weeks, Neil shared an article with me just the other day. The IRS and the Treasury, they have pointed out that could cause some adverse tax impacts on few people and scenarios, but that potential is out there, and they don't currently have legislation that would allow them to show any grace for those situations. And so they are asking that to be legislated to help out and kind of prevent problems. And so just be aware of that. That's been thrown out there. And so there could be some things coming down the pike with that. I've got a few different charts I want to skim through, again, just to kind of set the stage on interest rates and where they are and address some topics that maybe you've had come up. And so this is a chart of Libor. We took it off the Federal Reserve website. Libor is a commonly used index, and a lot of times lines of credit are based upon Libor, whether it be for a business line or high net worth individuals often borrow at Libor-based lines of credit. And you can see when people say interest rates are zero, they're talking oftentimes about Fed funds and Libor. And you can see for years we were accustomed, coming out of the Great Recession, we were accustomed to a really low, almost zero interest rate environment. And we started to creep up as in the last couple of years as things started to look better and the economy was rebounding. The Fed determined that it was time to start increasing rates. They came under a little bit of pressure and scrutiny towards the end of 2019, that they'd gone too far too fast. They started reining that back in. And then, of course, COVID hit. And to stimulate the economy, we had to drop them right back down to zero. And so you can see people are talking about low interest rates. We were accustomed to that not so long ago. You can see here we were right there. And so why might people be talking about it more so? If we go to the next slide, gives us, so this is the 30-year Treasury and the yield of that going back into the 80s. And so what we do see here, the thing that's different about this most recent cycle is that, yes, interest rates are low, LIBOR is back to zero. And so you might say, well, rates are right back to where they were. The difference is the long end of the curve came down with it this time. And so that's why the mortgage market probably had the busiest year it's had, at least in my lifetime and experience this past year. Everybody's going out and restructuring their loans. You can see with this curve here that it dipped below, fair amount below what we had seen in the previous, zero rate environment on the short end. If we go to the next slide, a lot of people, there's been a lot of talk, a lot of rhetoric about negative interest rates. And what does that mean? Is that even possible? The answer is yes, it is possible. We've seen it, not here in the US, thankfully. Everybody from government officials to the Fed to everyone, nobody has any interest in having negative interest rates here in the US. That would not be something that we would view as a positive. But if we look over to Europe, so this is the aggregate 10-year yield across several European countries, and we can see this chart was pulled a couple of months ago. You can see that it dipped down. It did dip down below zero. And so you might have heard, I believe, shooting from the hip here, I think it was Denmark at one point actually had mortgage rates that were negative. So if you can try to fathom that, going out and borrowing money to buy a house and you're actually making a little bit of interest off of it. So it is possible. We hope it doesn't happen here, but it has happened before. This is a slide just to kind of, to keep it all in perspective. Interest rates are low. But, we're coming out of, we all talk about the 80s and the high interest rate environment that we experienced then. You can see here, you've probably heard, if you're not old enough to have experienced it, you probably heard your parents talk about the horrific rates that they used to pay to borrow to buy their first home or a car or whatnot. That was something that we went through. But if you roll the clock back, way back into the 60s and 50s, this is a chart of the bank prime loan rate, which is also a base rate for a lot of loan products. And you can see we have been here before, way back in the day. It's been a long time. Some of us weren't around to even see that. But this is an interest rate environment that we have experienced before. It's just something we've not experienced in a really, really long time. So from that, I'll kick it over to Neil. He can talk to us about taxes, which are always fun.
Yeah, thanks, Jonathan. Yeah, I'm not ashamed to say I do think taxes are fun, and so we're going to talk a little bit about that. I know we've got a lot of professionals and academics on the call too. So in the breakout rooms, I'd love to hear what you all have to say on the tax front as well. But as Jonathan mentioned, really interest rates and taxes were the two things that came out and really were the most applicable to 2021 and how businesses and individuals should plan. And so I know we want to keep it at a fairly high level today and want to talk through a few of the tax issues that we see coming up and that are relevant potentially for you and your businesses. The first thing I want to note here on that first bullet point is that right now everything's just proposed. I know there's been proposals in both the House and the Senate, but they're just, nothing has, to my knowledge, has really moved forward. There's been no strong debates. Most of the debate has been just in the news and the financial press, et cetera. So right now, we're sort of in the stalking horse stage where everybody's just kind of kicking things around and seeing how they resonate. So that said, where do we know we are then? If you look at income tax, we know that right now the individual and pass-through income tax rules currently have a sunset at the end of 2025. So even if nothing happens, which sometimes is a good bet when you look at Congress, even if nothing happens, they are going to change. Income tax rules are going to change. They're going to revert back to pre-2018 at the end of 2025. So I think it's, if you had to pick a third theme for this presentation, that would be flexibility, right? You got to be flexible enough to have one eye towards what we know is the current rules, but another eye on the income tax side to know that things could change and they could change very quickly. I want to also talk a little bit about estate, gift, and generation skipping transfer tax. And those three, from the federal perspective, are often called the death tax. I think estate tax probably gets most of the press there, but they do all work together, kind of in concert. They're separate and distinct taxes. What we want to do is make sure that you and your clients or the people you're talking with are aware of their situation. Right now the estate tax exemption amount is $11.7 million, and that can be, that's for each individual person. So if you're married, it's 23.4. That's quite a high number, and the reality is most of the people in the United States don't have that level of assets. So the estate tax isn't an issue. On the other hand, a lot of business owners might be having this issue, and it's something that we want to make sure that people are at least talking about. There's a few things to think about. One of the things we talked about there on the slide is regulation 20.2010-1C. That's actually a regulation that says if you are smart and you do some planning and you use your exemption amount now when it's high, and later on, the government says actually the exemption amount is going to be lower. So it goes from 11.7 to take your pick. It goes to 10 or 3.5 or 6, whatever the number is. They're not going to penalize you for being proactive and doing planning. And so that's one of the things, we're not saying everybody needs to go use their exemption amount, but it is something that we do strongly encourage people to take into account and to just to look at, because, it can be very important. And the last thing we want you to do is sit here and a year from now or 2 years from now and say, man, I wish I had done something. especially when the government's kind of giving you a hint of you might want to do something sooner rather than later. The other thing from a non-tax perspective is, even if you don't do anything, this is a very positive thing for family businesses, because it forces you to talk about business succession planning and where your business is headed and where your holdings are headed. I'm going to go down to that fourth bullet point there on state and local tax. That has nothing to do with Congress, so we're not going to beat up on Congress or anything. But we do want to note that there's a Supreme Court case that was started, or the initial papers were filed in October of 2020, and it's New Hampshire versus Massachusetts. Now, we're sitting here in Kentucky and Indiana. Why are we talking about New Hampshire versus Massachusetts? Well, that's because right now, well, let me back up. When the COVID pandemic started, basically what happened was everybody got sent home to work from home if you could. What Massachusetts did was they continued to tax people as they had before. So if you are a New Hampshire resident working for a Massachusetts company, but you're now working out of New Hampshire in your home instead of Massachusetts continued to tax them for state and local tax purposes. New Hampshire, being the live free or die state, and not having their own income tax, didn't like that very much. So they filed a suit with the Supreme Court. Right now, there's not been a whole lot of action on it. The last thing that happened was that I could find was from January 25th. But wanted to just note that this is something that potentially could have some impact on you if you have people that are working for you in your business, and all of a sudden their withholding, the Supreme Court says their withholding has to change, or there could be some potential compliance issues. This could be a nothing, but it could be something that you want to take a look at. So those are kind of the highlights of some tax issues from a big picture perspective we wanted to note. Terry, if you could go to the next slide, thank you. So this one is kind of a combination. I told you, Jonathan told you interest rates and taxes are the highlight of our talk. Well, this one combines both those concepts, and that's the concept of value freezing. PNC Wealth Management, we're a trust company in part, and so this is something we thought was very applicable. Essentially what value freezing is it's an estate tax concept, where you can place assets that are growing into a structure that will limit the growth or freeze the growth for estate tax purposes, but still obviously the asset itself will continue to grow and hopefully continue to benefit your family. There's lots of ways to do it. Two of the more popular ways are listed there: sales to intentionally defective grantor trust and grantor annuity trust, or GRATs. Wanted to note on that third dash there, the 75/20 rates. Here's where, instead of tax, the interest rate comes in. The government actually will assume what the assets you place into these vehicles will grow at. This is specifically for a GRAT. In March, it was 0.8%. In April, it's 1%. Actually, in May, they've already announced it. It's 1.2%. So those rates are increasing. You might say, Neil, why are we talking about this? We're talking about this because the higher the interest rate goes, the harder it is for those value freezing techniques, those planning techniques, to actually make sense and to actually work and benefit your businesses and estate plans. As a point of reference, and note there, in April 2 years ago, it was 3%. So it's still historically low, but that window appears to be narrowing and appears to be closing a little bit. So it's something that we definitely, suggest that you talk to your clients, talk to, to owners about, because it could be a chance that that's not going to come around again for a long time. The last thing, again, I'll say is these freezing techniques, they are a little complicated. You could go to the next slide, Terry. Thank you. But what they do is they they're more complicated than just setting up, say, an IRA or just an account. What they do, though, is they promote discussion among the family and among the business owners. So it can be a really good exercise to really nail down your planning and make some good long-term long-term plans. Wanted to note here on the value freezing side of things, just what a sale to an intentionally defective trust would look like. So you'll see there are a few moving parts, but what it does, I'll walk through it for a second. In this case, you got Jane Doe. There's actually two transfers to the trust. There's both a gift or a seed, seeding the trust, and then there's a sale to the trust. The trust would then make note payments back to Jane Doe. Oftentimes, they're interest only in the beginning. Anything over that would then pass out to the IDGIT on the far right, or the intentionally defective grantor trust on the far right side. I promise you, I'm not going to try to make you all estate planning attorneys during this short call, but did want to just show kind of a format of how it would work. It's not magic or anything like that. It's just some complicated tax planning using both the income tax and estate tax rules. If you don't mind going to the next slide, Terry, I appreciate it. So one of the things that again, we've talked about is just how much the world has changed. I know that's the phrase, the new normal, has become kind of cliche at this point, but there is a kernel of truth there. And so, Jonathan and I have been talking a lot of times. We'd have clients a year ago who'd said, hey, I'm not interested in selling, not interested at all. Not going to sell ever. And they're talking to people about selling right now. So we think it's a really good idea to take a minute and work on your business, not necessarily in your business, and figure out what the business is worth. Always keep an eye towards that, and figure out who you need to talk to if you do want to look at doing any sort of planning, whether it's estate planning, business succession planning, or otherwise. Jonathan, do you have anything to add there?
Not other than basically just touching on the same point that Neil just made. That, the private equity markets sure seem to be flush with cash. I mean, we've had clients, again, like Neil said, that had zero intentions of selling, 3 to 6 months ago, and then out of the blue, there's this huge transaction taking place that, they've had an offer that they just can't turn down. And so, trying to do that planning on the back end it's rushed and it's difficult. And some of it is riskier when doing it in a short time horizon like that versus having set those plans in place beforehand. So, planning, it's planning. Planning is always best done in advance. And so we would encourage you, to kick these ideas around, think about them, even if that's not, something that you have on your own time horizon. It's wise to at least put some thought to it. I did see a question in the chat from Wes. He asked about who are the winners and losers, and who benefits from negative interest rates. And the quick answer is, those who benefit are those who need to borrow versus those who have excess assets. And so it's done to stimulate economic growth, just like low interest rates are done here. But then it becomes problematic because it starts to give you an issue of, where do you, if you have assets, where do you put them? If lending money draws you a negative interest rate, and that's about as good as you can do, it's inflationary. It starts to drive asset prices higher, because why would I put money in a fixed income instrument if I'm going to have a negative return? I might as well go buy a hard asset. And so it drives asset prices. It drives economic growth. Businesses with weaker balance sheets that carry a lot of debt, it's going to benefit those companies. Stronger companies that are established and have assets, it's not going to benefit them so much, because then they're going to start having to scramble as to what they do with those assets and be strategic with them to hold the value. So not a good place to be. And obviously, why have they done it? It's just kind of a response to where they view the economics of their region. So
the last thing I do want to note with everybody is we did put together a checklist. It's pretty comprehensive and covers all sorts of topics, from estate planning to just normal, financial readiness and responsibility. So we will be sending that around as well. So I think, Kristen, I think you're up.
Thank you. Thank you so much, everybody. We're going to have the same topics, but sort of switch gears, if you will, as how to play those topics. So financial planning for the future, enhancing your retirement plan. So along the lines of low interest rate environment, tax strategy, financial well-being of your people, and then how to protect yourself. So the first slide here, I am the Senior Retirement Plan Advisor for PNC Louisville and Lexington area. And my clients are corporate clients with corporate retirement plans, 401k plans, 403b plans, whatever the number is. It's a DC plan set up for saving for retirement for you and your employees. So on the low interest rate environment, we were ticking up in the rate area before COVID hit, our pandemic, and now we're at a ultra low rate environment. But within DC plans, your 401k plans, and even your 529 plans, they can offer a stable value fund, or sometimes called a GIC, or a fixed account, where you can't get that anywhere else. You can't get it in an IRA, you can't get it at your bank, you can't get it in your CD, you can't get it anywhere else. And what a stable value fund is, it's your cash option in your plan versus your money market fund. Money market is fighting to provide yield right now, while stable value funds last year, the ones on our covered list delivered 2% to 2.5%. So what stable value funds are, majority of retirement plans out there provide a stable value instead of a money market. And the reason why I was trying to look for that yield, but what a stable value fund is a collection of bonds. It's a bond portfolio, usually shorter term, but then it's wrapped by an insurance provider or several insurance providers. So the value stays at $1, and it can provide additional yield compared to money market funds that are very restrictive within 401k plans, where they can only, 30% of their money market has to be invested in things that can liquidate within 5 days. So that keeps the ceiling very low for its yield. Now, with these stable value funds, with this portfolio of bonds wrapped by an insurance provider, it creates some uniqueness to it. So you have to be aware of a few things when you're exploring a stable value versus a money market fund for your retirement plan, and to offer it to your participants. One is the cash flow that goes in and out of a stable value fund has a huge impact on it. And if it's flowing out a big outflow when the bond market's down, the insurance providers come in and shore it up. So they want to keep an eye on the flow of the money. So what they do to protect that is they say if it's a competing fund in your plan, and each provider will name a competing fund their own way, but most of the time it's a fund that has a duration of less than 2 years, something like that. A participant can't buy and sell back and forth between that competing fund and the stable value fund. They have to put the money somewhere that's not competing for a while, for 90 days, to purchase back into the stable value. So that's something that's unique to it, that hits at the participant level. Another thing that's unique to stable value funds is that if you go as a plan sponsor and you want to make a change, you have to give them notice. And I mean notice, we call it a put. 1 year to 2 years is typical in the industry. Seen some as long as 10 years, never signed a 10-year put. But nonetheless, so you got to give them notice so they can start getting those assets together to liquidate without having an impact to the rest of the holders. And then when you go to explore it and you're looking at it, you need to look at the financial condition of the insurance providers that are protecting this stable value. There's stable value funds out there. There's T. Rowe Price, there's Putnam, there's all kinds of different variations, and they hire or they work with insurance companies to wrap them up. So you'll look and see how many insurance companies wrap the stable value and what's their credit rating. So those are some things to consider. to help accommodate this low interest rate environment. But I couldn't be more excited about, believe it or not, a stable value fund and 401k plans. It's one of our best kept secrets, if you will, because you can't offer it in IRAs or anything else. So Terry, if you'll go on. The next theme or strategy within your retirement plan, and this may be very simple to a lot of you all, but it gets overlooked from time to time or not enough focus on it, but that's the Roth 401k plan feature. So I'm sure everyone in the audience knows, but just to help the students, Roth is a feature where you pay taxes as you make the contribution. You pay taxes today as you make your contribution to your Roth IRA or your Roth within your 401k plan, and you never pay taxes on them again or the earnings of them again, as long as you follow a few rules. Never pay taxes on the earnings of them. So if you're young and you're going to work at Churchill, you sign up in the 401k plan, you may want to look at, see if they have a Roth feature and invest that way, because you'll know you have 30 years of time ahead of you of building your wealth in that retirement plan, and to not pay taxes on 30 years of earnings, that growth it has is phenomenal. It's a wonderful tax strategy. A Roth within your 401k plan, I believe, is simple as good as sliced bread, meaning some people can't use a Roth IRA because their AGI, adjusted gross income, is too much. There's a cutoff. Well, within a 401k plan, there is no ceiling on your AGI. They don't consider it at all. You're able to save to the maximum that the IRS code allows, which is currently $19,500 in your own name. If you're 50 or older, you can add another $6,500 to it. So quite a bit of money that you can save within the Roth, and again, never pay taxes on it. If an employer makes a match or a contribution, those are always the traditional tax deferred. So if you're putting away in Roth in your own name and your employer's matching, you got a tax strategy right there when you go to retire. Another thing to realize is that within the 401k, a Roth, when you hit 72 and you got to take your required minimum distribution, you're required to do it within the 401k, even if it's Roth. But if you roll it out, which you're allowed, and put it into a Roth IRA, you're not required to take a minimum distribution as of now in a Roth IRA. So a lot of tax strategy tools just with this Roth alone. And if your plan doesn't offer Roth for whatever reason, I have clients that don't, they got to work through some payroll concerns, but still focusing in on it. The competitors are. 69% of other plans are providing Roth within their plan. And Roth just doesn't mean just the contribution, but you can also allow Roth rollovers for your new hires. And I would suggest you really want to look at that, because if you don't allow Roth rollover into your 401k with your new provider, with your new hires coming from another plan, and they roll it into a Roth IRA, as of now, the law won't allow a Roth IRA to roll up into a 401k. They just don't allow it yet by the law. And then a third thing to consider is allowing Roth in-plan conversions, meaning if you have your Roth contribution, will you allow people to convert their traditional after pre-tax dollars into Roth and then pay the tax bill outside the plan? Huge tax strategy, strategy plan that can be in place for your people. You do want to make sure that they're aware that they can't use their account to pay the tax bill. They'll get a 1099 at the end of the year, and unless they can take a loan or something, they have to have the cash available to pay that tax bill. So tax strategy within the retirement plan. Now, your employees. So on the employee front, with all the market volatility from COVID, with all the political front, with low interest rate environments, talking about negative interest rate environments, talking about financial stress, maybe brought on by COVID or amplified because of the pandemic, it's very important to consider your employees and the financial stress that they're enduring at the time. And what do I mean by that? The middle point here is that there's been studies that show that if you have employee that's under financial stress, it can cost your company $1,900 on the bottom line per year. And absenteeism and just many other loss of productivity and whatnot, but $1,900. So most people say, okay, well then, maybe we should help them. And it says that 87% of Americans are stressed about their current finances. In that, unfortunately, 40% of Americans have less than 25,000 in their retirement assets as we go to move to retire. So what can you do as an employer to help with this? If you'll change the slide, Terry. You can look at your financial wellness programs within your own retirement plan. A lot of record keepers provide them. It's there, it's a resource, it's an underused resource, it's an underknown resource. But look, if you have Fidelity as your record keeper, by all means, they have a financial wellness program. And if you get HR involved and get contests and just really bring it to the forefront, or a drip campaign, just to really help them out. And the reason why it's so important, if you'll look at the middle point there, it's a 78% of employees that are stressed about their finances can be attracted to another company that they believe cares about their financial well-being. So in this environment, getting employees to show up for work, getting employees productive, and retaining them is very important. And it showing them that you care about their financial wellness can go a long way. So again, you can just start with your record keeper, see what programs they have available at no additional cost. And then you can go, and there's definitely outside programs available that can be purchased as well. Terry, if we can go to the next slide. Now, within your retirement plan, we've talked about the low interest rate environment, maybe the stable value funds or GICs or fixed accounts instead of a money market. We've talked about Roth as a tax strategy. We've talked about your employees and their financial well-being. Now let's talk about the company and buttoning up your liability to offer these retirement plans. No new news here. 401k plan and quite a bit of 403b plans are under a body of law called ERISA, and that's the most stringent body of law, even more stringent than the trust body of law, and it holds fiduciaries, and that means plan sponsors, corporate plan sponsors, and people overseeing the retirement plan for the company to a very, very high standard. So an insurance policy, we're not talking the fidelity bond of the retirement plan, which is required by law. This is not required by law by any stretch of the imagination, but usually it's bundled up in your package, your insurance package from your insurance provider. I'm not a broker, not even going to pretend to be, but look at your fiduciary liability insurance, see that you have a policy, and if you do, look under the hood a little bit. The third bullet point really points out, make sure the policy covers the people that actually administer the plan for your company. Like if you have a committee and you have someone that's from rank and file to represent that portion, make sure that the policy covers that rank and file person being on the committee. That's one of the bigger concerns with those policies. Also, lawsuits are up. I'm not here to scare anybody, but lawsuits are definitely up on the ERISA front for breach of fiduciary duty. So fiduciary liability policy premiums are on the rise if you have a larger or mid-size plan. And if that's the case, you can go back and negotiate with your broker and show them what you do to button up your plan, meaning you meet regularly with the plan providers, you have an outside advisor on the plan, you have an investment policy statement, you have looked at cybersecurity, just what have you done to monitor the investments, to make sure the fees are reasonable, that you've done your duty, and then you can negotiate down that premium for the policy. So with all of that, that's the presentation on the DC 401k front. I think we can open it up for questions.
Okay. I sent a chat out to everyone just a minute ago asking for if there's any additional questions. So we'll just wait to see if any pop up here.
Well, while we're waiting, I can also announce the winner of the gift card,
Yeah.
chosen by a random number generator.
Oh, all right.
It is Cordell Lawrence.
All right, great. All right, congratulations, Cordell. Cordell, of course, is a longtime member of FEI. Let's see. Well, thank you, everybody. I think what we can do, well, Bill Furco had a good question. He said, please discuss family office structures. And if you'd like any more color on that question, we can unmute Bill to expand on that, or is that enough to be able to take it away?
Yeah. I'd like, maybe a little bit more color on if there's any specifics there. It'd be helpful.
Yeah, let's, Terry, can you unmute Bill?
I think he can unmute him. So.
Okay.
Okay. I just know some friends have moved assets into family office structures in an effort to do estate planning and to also try to minimize taxes that estates can be subject to. So that it's all bundled into one question.
Yeah, I'll take a crack at it, and I don't know, Jonathan, if you have any thoughts too. I mean, I think to my mind, a family office is kind of depends on who's asking the question and how they're defining it. You know, so sometimes a family office is just basically bookkeeping and maybe an in-house part-time attorney or something like that. Other times it has much more structure built around it. So I think how the family office evolves and what its purpose is very important, obviously. I think in my experience, family offices aren't typically going to, the family office itself is just the administrative structure around the planning. As far as, you know, the trusts, et cetera, are going to be distinct from the family office. They're just going to be administered in some form or fashion by the family office. As far as how to do that, I mean, there's as many different ways to set up one as you could think of. Sometimes, you know, institutions have an offering that they call like their ultra high net worth offering or family office offering. Other times it's just, you know, I've seen where it's just a CFO kind of come in and move into that family office role. So I think it's really fact specific, but I don't know if that's really answering your question, to be honest.
No, I was more interested if there's ways to avoid the trust taxes, if you would, go to the top marginal individual rate at like $12,000 of income. Mm-hmm. So, I mean, if there's a way to get a better tax treatment than trust marginal tax rates after whatever it is, $12,000 of income.
Yeah, no, that's a good question. I mean, and that's part of the reason why a lot of times people try to move the income out of the trusts, you know, because then it's going out and it's taxed the individual at the individual's rates. And that's not always possible. And most of the time, capital gains are taxed at the trust level too. So, you know, if you have a sizable amount in there, it's going to be taxed at you know, the highest rates. So yeah, I think trust, one of the benefits of trust, which is not so good for income tax reasons, is you're able to do things like make them generation skipping, transfer tax exempt, which you can't do with others. So again, it really always depends on the situation as far as what the long-term purpose of the funds are. You know, trusts aren't good for everything. without a doubt. So it is unfortunately really fact specific.
Yeah, it's really situational. And Neil, that IDGIT example you gave in the presentation is a scenario where the income actually is taxed at the rate of the individual. Is that correct?
Well, yeah, in that case, that's an intentionally defective grantor trust. And in that case, it's taxed as a grantor trust to the individual. So it's sort of a quirk or situation where the person starting it, I think it was Jane Doe in that situation, she would actually continue to pay the income tax on that trust on her individual tax return, which that's where the defective trust comes from, and that's actually by design. So it is possible, to Jonathan's point, it's a good point. You can make them grantor trusts where they're taxed as an individual, but really just fact specific and what a particular family situation is.
Yeah, it depends on what stage and life cycle the trust is in as well. If it's at the point where it's actually benefiting, future beneficiaries, oftentimes that income is being pushed out of the trust to them anyway, at which point it's being taxed on their own rates versus that of the trust as well. So again, I always tell people trusts are never one and the same. There is just a universe of options that you can choose when looking at a trust, and very, very broad topic. And so it's hard to put it in a silo and set hard rules around it. But
Thank you.
There was another good question. I think we can fit in one more, or maybe two, before we get into our small groups. But there was a question about, let me make sure I read it correctly from our chat. What are some of the reasons 401k plan sponsors are getting sued by their participants?
All right, I'll take that one. I had to unmute my mic. I apologize. So breach of fiduciary duty, and the majority of the reason is fee front, not keeping an eye on the fees paid by the plan. So plan providers are your record keeper. You can have a TPA, third-party administrator. You can have an advisor, and you got the funds themselves. So think about a mutual fund, let's just call it Vanguard 500 index fund, but they have share classes. So there may be an Admiral share class where you're allowed to purchase if you have just say $1,000 balance. But once you get to where you have $10 million, you can go to a cheaper share class. And a lot of lawsuits have come where the plan sponsors were unaware that cheaper share classes were available to the plan. They've crossed that threshold, and the plan continued to pay the more expensive fee, even though they didn't make use of economies of scale, if you will. Mm-hmm. That's absolutely one of the reasons. Another reason, which may not have merit, is not being in the best investment at the time. So one of my long-term clients and really well-respected ERISA attorney has always said, you do not have to be right, but you got to have a process that got you to your decision and you document it. So there have been lawsuits that stable value fund wasn't used when it was available to them instead of a money market fund. Well, nowhere does it say you have to. You just document why you didn't. So fees and investments.
Excellent. Thank you. Let's do this as a last question, and if we need to get more color on the question, let us know. We can unmute Wes. But any experience with companies using a cash balance pension plan for transition planning?
Wes, will you unmute your mic and add some color to that? Cash balance plans, ESOP plans, and deferred comp non-qualified plans or additional plans out there that companies use to transfer wealth or from owners to employees and whatnot. But what's on your mind there, Wes?
Yeah, that's where I'm going. ESOPs are another good one, but cash balance is one that I've heard about. I've seen some others use it, but haven't had a lot of experience around town here hearing about it yet. But a cash balance plan is a pension plan, and it's a tax deferred vehicle like your 401k, but the deferral limits are so much higher.
Mm-hmm.
So in other words, where your limit in a 401k is maybe, where are we at, Kristen, 60,000 or whatever it is between your
Mm-hmm.
deferrals and a profit sharing, in a pension plan or a cash balance that, you could get up to $250,000 a year. So if that's the case, I've seen and read about some cases where people will set up kind of I guess a wealth transfer scheme, if you will. So over the next number of years, these large contributions go into the cash balance plan such that when the owner gets to retirement age, then they essentially have a withdrawal of this balance. But of course, the cash over the life of the plan has been coming out of the business. Does that make sense?
No, absolutely, and that's perfect. I mean, it's another. You're absolutely right, and you brought it to light. So thank you for that. Another vehicle to use to save for retirement or transfer wealth out of the company, like you said, because the company's making the contribution. And if it's a family owned or, you own the company, it's a very valid way to do it. We can, after this, send additional information on plans like the deferred comp on qualified plan, which is an ERISA plan, can only be unlimited key people, the ESOP, transfer of wealth from the owners to the employee base, or cash balance plan. But Wes, I thought you were getting really creative, like the cash balance plan was purchasing something from the family.
Yeah. I was going to say, yeah, Wes, I mean, we definitely see people using them, kind of like Kristen saying, they're wonderful tools, especially, if their age is right and the financial situation of the company is right, it can be absolutely wonderful. But yeah, in my experience, they got to be part of a larger transition plan. But yeah, I think they can be great.
Yeah, it's something I thought that's I've read a lot about. I thought I would start seeing more of it, but I just haven't seen a lot of it yet. So you're right. It's not going to work for every situation, but it's for the right situation, it can be a beautiful thing.
It can be a beautiful thing. Yes.
Yeah, I think part of it is I think, and I'll defer to Kristen for sure, but you have to make sure the ages of the employees and the ownership kind of works right for what their goals are. And I think they probably get talked about in my limited experience more than they're actually used. But yeah, they're wonderful tools.
Yeah, I mean, you got to be prepared as the business owner to make a healthy contribution to your all employees. Not as large as you'll receive, but if the money's not there, and you sort of have to have a 5-year commitment to it. So you got to have a comfort level of your 5-year cash flow or business. And in this environment, I don't know if anybody has a 5-year comfort level. So that's why it may be talked about more than executed. But we do have some clients that absolutely have launched some cash balance plans in this environment.